Charts and coffee. Great to see everyone. Happy Monday. Happy August. Brand new month ahead of us. New sheet, new chapter, new page, however you want to look at it. Hopefully everyone spent a little bit of time over the weekend taking a look at their July results. What did you do well in July? What did you, maybe not do so well? And where can you improve? And that's something that I'll do at the end of every month as we go into the last few trading days of every month. And that's where I grade myself. A lot of folks will look at their account balance or look at their winners and losers for that day every day. And much like they say, when you're trying to get healthy, don't weigh yourself every day. Well, the same thing is true for trading. Don't grade yourself every day, maybe once a week, definitely once a month. And what that allows you to do is remember two really important things. You're not in it for one big home run. You're not looking for that one big trade that's going to change your life, although I think a lot of traders actually are. So maybe, work on that. But the most important thing is you let your process, the probabilities, play out over the course of multiple trades. And the only way you're going to know and give the time for those probabilities to play out, that win rate that you have either tested or experienced based on that strategy in the appropriate market, that's the only way you're going to know. I don't grade myself on my day trades, even though, much like a batter knows they went 2 for 3 for that game. I'll know that, but I don't live it. I don't own it in a way that either gets me too up or too down. I play it out for the whole week. I step back and then I say, all right, where are we at for all the day trading that we did for the week, or all the swing trading that we did for the month, or where is my portfolio this quarter, right? So be really careful about how frequently you judge yourself or your trading. Really, really important. All right, the other thing that we're going to be taking a look at here today, and I'm going to take us over to the economic calendar. Not a busy one for today. Not a busy one at all. However, we do have a single hot zone to contend with. That's going to be right at the top of the hour, the next hour, and that's our ISM manufacturing PMI. Generally speaking, the manufacturing PMI is a more important number to me than, say, the services PMI, but nonetheless, it's definitely something to keep an eye on. The hot zone is going to come at the very end of the clearing range. So when we have our clearing period, 9:30 to 10, right at the end of it, we're going to have this volatility burst, this hot zone. It will increase the probability that we might have possibly some false breaks. We won't know that for another 57 minutes. But just keep in mind that when we get these 10 a.m. volatility events, sometimes the movement that accompanies them is not necessarily reflective of what we think about the levels that were established during the clearing, but rather the momentum that was generated from the hot zone. Makes it a little bit tricky. Luckily, we don't have that many high impact hot zones at 10 a.m. throughout the month, but this is a red hot one, as you can see here. All right, so the next thing we want to do is take a look at market structure. Where are we in terms of market structure on the indices? So let's take a quick peek there. All right, S&P. Take a quick peek. And yes, you can see here, since about 7:45 a.m., we've been heading sharply lower. One of the things that we've been talking about is juxtaposing two main things on the chart. And that is, yes, July was extremely optimistic, did not turn into an uptrend. We're in a neutral chop with a previous bearish downtrend, so a little bearish to neutral with the approach to the chop, which means, yes, I am at the top of the range that we've travel to, I am a little bit more bearish at the top of the range. And where is that top of the range? Well, we've been relying on the Darvis levels to determine that. And you can see here, we are in a fairly wide 4,100 to 4,200 zone. And frankly, we've been overbought on the stochastic for some time. What we don't have is the sync, what we don't have synced up is reaching a Darvis resistance or a Darvis zone, or maybe the 200 exponential and an overbought stochastic. What we also have is, as we've progressed through July, we've seen, and this is going to affect our swing trades. This is going to affect our daily timeframes. We also see that the columns, right? If you've looked at the Fed target rate probability that I've shared with you all multiple times throughout the last few months, if you're taking a look at the Fed fund futures and how those futures then, the CME has set up an amazing graph. If you've never looked at this before, please do acquaint yourself with it. It will absolutely be the magic decoder ring to understanding macroeconomics in this season. And that is, we have been coming off of the 350 to 375 column, which is widely been throughout the year where the target rate probabilities were heading to. We came down to 325 to 350, and we're in the second tallest column on this graph. Really interesting. The second tallest column on this graph is the 300 to 325. Now you might say, Rog, okay, I get that we have different height. Let me grab my drawing tools here. I get that we have different height columns, but what on earth am I supposed to take away from this? Here's how it works. This is where we were, and this is what we were anticipating for most of the year. We know then that this is 1/4 point less a hike than we've been discounting most of 2022. And this is 1/2 point less a hike than what we've been discounting throughout 2022. That movement to the left on this graph, stocks are going to like. They are going to be happy about this. Okay, recession, what recession? Earnings, who cares? The Federal Reserve may not hike as much. That's it. Everything else is just blinders on. Because remember, it's the Federal Reserve that got us to these heights in the first place. Printing money, keeping rates ridiculously low for a very long period of time, even though during the beginning of the pandemic sell-off, they empowered the Treasury to buy stocks. I mean, think of everything that's happened over the course of just even the last 3 years to help move the market higher. All of it, if you kind of follow the path of where it came from, right? Follow the yellow brick road. All of it came from different ways of being accommodative, right? Different ways of either printing and adding liquidity to the system. I mean, that's if you want to get really basic about it. There was a cool image that I shared with you all last week, and I think it's really important to go back to that from time to time, because the Federal Reserve's arch nemesis, and let me see if I can find that image because it is a great one, but the Federal Reserve's arch nemesis is inflation. And if you take a look at M2 money supply, here we go, we can see that as M2 drops, so too will inflation. In other words, we're printing less, so inflation should go down. I know. Thought that would be pretty obvious. Really important to remember that one does lead the other in this case. All right, so that's where my head's at right now, gang. Yes, we can sell off even though the bottom is in. I get that question a lot. Raghee, you saying the bottom is in? What that means is that I don't believe we're going to reorganize into a downtrend. We're going to stay in chop. That does mean we can move from overbought to maybe the midway of the range, maybe even to oversold again. But that doesn't mean we've turned back into a downtrend, right? I think the downtrend days are behind us because we can see a very clear map to a far shorter end to the rate hikes. All right, with that being said, I can see some questions are coming in. So let's go ahead and tackle those. And first up, good morning. Good morning. Okay. So Willie asks, do tops, does the obnoxious profit strategy cover day trading on the 5-minute? No, the tops tools, TOPS, obnoxious profit, those are just a group of indicators. And I was and back in 2016 or 17, myself, Trish, and Craig, one of the folks back at the office, were sitting around thinking about what to call this thing. And at that point in time, based on some trends, I was killing it. And Craig was saying, gosh, that's obnoxious. I said, it really kind of is. And so this little inside joke became the name for that layout, TOPS, TOPS. The tools that I use in TOPS are part of the tools that I use for everything that I do. Willie, weekly portfolio, daily swing, 5-minute day trading. But if you're looking specifically at my day trading, if you're curious about how I do that, by the way, I'm going to be in the Sector Secrets Mastery here in about 19 minutes. And I will also be in the options room this morning for the open. So if you're curious about how I day trade, my plan is to do some day trading in that room. So yes, every morning I do day trade from 9:20 to about 10:30, 10:35. That's my favorite hour of my favorite window in the morning. And we'll be doing a little bit of that. My last class, Willie, is what I would recommend, because depending on what level you sign up for, I don't know how we're doing it now that the class is done, but you do get access to, I think, don't hold me to it, contact the office, please. But when we did it live, depending on the level you purchased, you get access to the HPMRs, you get my day trading layout, et cetera, et cetera. And you can take a really good look at how I've been day trading this year, when we've been dealing with CHOP, when we've been dealing with this macroeconomic uncertainty, et cetera, how we're taking advantage of price and time and volatility and the 5 day trading windows that I have the choice to trade. So I appreciate the question. All right, next up, Ski asks, please comment on why I use the 200 EMA versus the 200 SMA. Sure. So if you go back to the late 80s, which is when I was cutting my chops as a very young trader, and into the 90s, you probably would not find a single trader who did not have the 200 simple moving average. What is SMA? What is a 200 period simple SMA? That means that simple moving average is going back 200 candles. It could be 5-minute candles, could be daily candles, could be weekly candles. It's going back 200 candles, taking the close from each candle, dividing, taking the sum of that, dividing it by 200. It's a straight average. And all of those closes have equal importance, equal weighting. Nothing wrong with that. It's probably one of the more popular ways of looking at what I call the equator. If we're trying to determine if a market is generally bullish or generally bearish, the broadest opinion is going to come from whether or not price is above or below that 200. Fast forward into the mid 90s and probably early 2000s, I started doing a lot more experimenting with exponential moving averages, because one of the tendencies we have is, we as people, we as traders, is we give more recent events, recent price action, recent highs and lows, recent support and resistance, more weighting in our mind, probably because we can simply remember it. So something that happened more recently in life and in trading tends to have more weighting than something that happened further back. Exponential moving averages weight more current closes heavier than the ones deeper in that 200 period look back. So the way I look at it is it builds in recency bias, which I believe is something that touches every aspect of life, recency bias. And that's why I started making the switch to exponential. I have noticed over the last easy 2 decades, decade and a half, exponential moving averages have taken on even more importance, even more broad-based acceptance. And part of trading using technicals is not to get too cute with the settings, not to change the settings off, and that's curve fitting anyways. It's to stick with what we believe traders are reacting to. A lot of times we want to fall into the fallacy that somehow indicators know what's going to happen. No, they reflect what's happening. Yes? So if we want the best reflection of the broadest psychology, we don't want to get too cute with indicator settings. Most of my indicator settings are usually some or default or very close to a default. And therefore, unless I've done a lot of back testing, or I don't even like to back test, quite frankly, what I like to do is find something I like and test it for minimally 6 months, preferably a handful of years, so I can see multiple seasons of the market. Seasons meaning not just uptrends, but uptrends, downtrends, chop, volatility high, volatility low, etc. Then come out of that testing period and say, gosh, for the last 37 months, this has seen all sorts of personalities and it's working really well and it stays. That's what the 200 exponential had to go through. And that's why I use it, Ski. And that's why all my exponential moving averages all my moving averages are exponential. There's no harm looking at the 200. If you want to put a 200 on your screen, just go to minimize. You can, but I have found the 200 exponential to be a little bit more accurate. Truth of the matter is, sometimes they are very close to one another. So there's no harm in looking at either. But I think the adoption of exponential moving averages has increased the response at those levels, whether it's the 21 exponential, the 200 exponential, 34, 55. You'll just notice they're just more and increasingly so influential over market behavior. So that's my reason. All right. So let's see what else we have here. Am I still bullish the dollar? So being bullish the dollar is the same question as asking, hey there, Tim, am I bearish the euro? Am I bearish the yen? And hang on, I'm going to grab my drawing tools here again. Am I bullish? Am I bearish the euro? Yes. Let me see, make sure I'm saying this right. To be bullish dollar, I have to be bearish the 6E, the euro. I have to be bearish the 6B, the pound, and also the 6J, the yen. The most important being the euro, then the yen, then the pound. But one of the things that I've been mentioning for some time now, probably a good 2 weeks, is that as the expectations for the rate hikes are coming in other words, gang, partly the reason for the ramp up in the dollar was the ramp up in the messaging and the expectations for fairly aggressive rate hikes. We kind of know where hikes are taking us. We're well past the halfway mark. And I think I mentioned this about a week or two ago. The best days for the dollar's parabolic, accelerated, strong uptrend are behind it. We are not on the new dawn of another push in the dollar. And that's just a blanket misunderstanding of what moves the dollar. We have other central banks, like the European Central Bank, that are entering their tightening phase. And that's going to put downward pressure on the dollar. We're at the tail end of the tightening phase in the US. That's also going to, keep buyers on the sidelines, because we're not in that ramp up phase. We're sort of, we're in the 8th inning here, really. We're in the 7th or 8th inning of this tightening cycle. If the yen starts to strengthen, if the euro starts to strengthen, if the pound starts to strengthen, that's also going to pull the dollar. Why? Because we're never, ever, ever trading just the dollar. In fact, it sort of makes me crazy when people say, let's look at the dollar. We're never looking at the dollar alone. We're looking at a dollar basket. We're looking at the dollar versus the euro, the yen, and the pound. So really, to get an idea of what UUP or DX are doing, we have to look at those other currencies and also their central bank policy shifts, which we're undergoing one right now in Europe. And by the way, we're winding down one with less money printing happening in the US. So the less money printing, you would think, would be more of a bullish catalyst. But the fact of the matter is, the bulk of what we were expecting, we got. So why continue to run the dollar up? Am I still willing to be a buyer? Yes, but this is not the dollar of earlier in 2022. So yes, I'm bullish. I'm willing to be a buyer, but we're going to be a lot more conservative about it. All right, gang, that is our show. Thank you as always. Heading over to the Sector Secrets Mastery room right now. So mastermind folks, I'll see you in a moment, and I'll be in the options room as well for the first hour of the day. Be good to each other, gang. I'll see you tomorrow. Same time, same station. Remember, we had our weekly Raghee report yesterday. You can catch that replay of that show back at the Simpler Trading YouTube channel. All right, gang. Be good to each other.